So over the pandemic, when it actually started and we saw lockdowns, pretty much everyone in the world thought that housing markets were about to collapse. But in the end, the absolute opposite happened, and we ended up with some weird housing pandemic boom, which was incredibly unexpected at the time and almost no one predicted. But in hindsight, it's actually quite easy to see why it happened. Now, in short, the reason it happened is because, well, firstly, a lot of people decided to move away from cities. They were suddenly working from home. They didn't need to be within 30 minutes or an hour of their offices, and they wanted a bit more space. If they're working from home, they maybe wanted a home office, they maybe wanted a bigger garden. So we saw a pretty large exodus away from some traditionally very valuable cities like New York and London and into the suburbs surrounding them or to competing cities instead. Now, at the same time, we had pretty much every Western government in the world throw money at people. In the UK, we had furlough. In the US, you had stimulus checks. We had helicopter money. Governments were incredibly panicked and worried about the idea that people would run out of money and they'd stop spending money, and then the economy would grind to a halt in some massive, terrifying recession. And it all stemmed from the fact that really lockdowns weren't allowing people to spend their money. So the governments resorted to just giving away as much of it as they could. And we saw this really weird phenomenon where during what should have been a recession, people had more money left over at the end of each month, not less, because they were still being paid for their jobs, but they physically weren't being allowed to go outside and spend that money in the way they usually were. We also had a labor shortage, which meant larger bonuses for a lot of people. It meant pay rises for a lot of people. And while in the end, inflation did catch up and end up running rampant and far ahead of those increases in wages, well, at first, we basically saw a lot of people had a lot of money. And so people started looking to move house, usually upsizing, usually to a newer, nicer area. And so housing prices boomed across the board, not just in the US, but in Canada, in the UK, in Australia, in France, in almost every Western nation in the world. Now, this isn't breaking news. You know this, or if you don't know this, I'm thoroughly surprised. This article here is from the Dallas Federal Reserve, and it's literally just them analyzing why housing prices soared so much as the COVID-19 pandemic took hold, as you can see. Now, as a result of this action, obviously, housing prices increased at a ridiculous rate, as we just mentioned. This here is a graph of the average sales price of a home sold in the US. And this bit right here is 2020, sitting at about $375,000. And then the steepest part of this graph throughout literally our entire history was the year or the years of the COVID pandemic. And now the average home price is $510,000 in the US. Now, these housing booms were particularly strong in certain cities where there was a lot of demand, in places like Boise in Idaho, in Dallas and Houston in Texas, in plenty of places like that. And as a result, housing prices in certain areas actually almost doubled in some instances. Now, there is, of course, a massive problem with this. There always is. And that's the fact that actually these sort of booms, when they're ridiculously strong like this, they always end. The steepness of this graph that you can see here should be a massive indicator of the fact that this isn't sustainable and that it isn't going to last in the long run. Now, we all know the state of the economy right now. If you watch this channel regularly, then you really do know the state of the economy. It's pretty much screwed. Inflation is insane. And so the only option that central banks around the world have is to try and just crash demand to stop inflation from spiraling out of control. As a result of that, interest rate hikes are literally mandatory at this point. They're happening all over the place and they're not going to stop anytime soon. Now, this is going to come with some unintended consequences, of course, and the biggest one that, of course, we're here to talk about today is the fact that this will crash the housing market in the US and probably in many other countries as well, and there isn't really a way around it, unfortunately. This tweet here sort of encapsulates the problem perfectly. 2 years ago, the 30-year mortgage rate was 3.13%, and the median existing home price in the US was $283,000. Today, the 30-year mortgage rate is 5.78%, and the median existing home price is $408,000. With a 20% down payment, that's a 96% increase in the monthly payment from $972 to $1,909. Now, to very quickly clear up some indiscrepancies there, he's looking at median house prices, whereas that graph I showed before was mean house prices, but the trend is exactly the same. House prices have absolutely soared by about 30% in his instance. And that was fine when interest rates were really low, when it was easy to get a 30-year fixed rate mortgage at 3.1%. And actually, a lot of people were getting them at 2.5% or low 2%. And as a result of that, their mortgage payments were very low. Now, though, there are two forces forcing them up. Firstly, we have the fact that actually you're getting out a larger mortgage in the first place to afford a more expensive home. And then we have the fact that actually the interest rate has doubled, which means that you're paying far more in interest every month. And so the average monthly payment for a mortgage has pretty much doubled over the course of 2 years. Now, this unfortunately means that actually nothing else really matters, and housing prices in the US pretty much have to fall because they just can't maintain these sort of increases. Now, if people's wages had doubled over that same period of time, then this wouldn't be a problem, right? Because the number of people who were able to afford a $1,000 a month mortgage payment would have pretty much doubled. And so those people who used to pay $1,000, well, now they could afford to pay $2,000 if their salaries had doubled. That obviously didn't happen. As a result of this, the only way for the market to continue to operate is for prices to fall, because there simply aren't enough people to maintain price levels at these new ridiculous levels when interest rates aren't at rock bottom. Now, a lot of people will say something along the lines of, well, you're thinking about this in terms of 2006, back when people didn't have fixed rate mortgages, and nowadays everyone has a 30-year fixed rate mortgage. But in reality, that isn't actually too important here, because house prices aren't determined by people who have a 30-year fixed rate mortgage and live in that house for 30 years. They're determined by the buyers and sellers, the active participants in the markets. And for them, their mortgages have to change. And so they can't lock in those 2 or 3% rates. They have to resort to new rates of 5 or 6%, and they have to transact at these new house prices of $410,000 instead of $280,000. There simply aren't enough people in the country who can afford these new higher mortgage payments to maintain these new higher housing prices. And so either mortgage payments need to decrease, and we've already established and discussed the fact that actually interest rate hikes are essential, so they're not going to decrease, which means the only way to find market equilibrium where actually people are transacting, when people are able to buy and sell their homes, well, that's for housing prices to fall. Now, frankly, I've been talking about this for quite some time on this channel in particular. If you go back and look through my videos from 6 months ago, you'll find videos about me talking about the housing market, and I tie everything back to the fact that inflation wasn't transitory back then. It wasn't going to disappear, and so the Federal Reserve was in the end going to have no choice but to raise interest rates. And basically with the new higher housing prices, that was going to force a market crash. To anyone who's actually been paying attention, that was quite obvious, and the lines of logic worked really easily. It wasn't a difficult concept to understand. But finally, legacy media organizations like Bloomberg are finally catching on and recognizing that this is just the reality. You can see this article here. We're already seeing the stock market sell off spill off into the housing market, and it's especially notable in places where stock-based comp is significant. Now, what they're talking about here is basically the idea that actually it isn't just interest rates rising which is going to impact housing prices. It's also the fact that the economy is struggling itself, and in particular, the stock market is struggling. We've all seen that the Nasdaq is down over 30% year to date, and the S&P is down over 20% year to date. Now, if you live in Silicon Valley and you work for a company like DocuSign, who I love to rip on, well, the fact that their stock has fallen by 80% in value, if half of your salary was stock-based comp, then you've lost 40% of your salary, and that's going to have a major impact on people's ability to afford homes. The reality is that the housing market, the stock markets, and the economy as a whole are all incredibly interconnected, and it's very rare for one of them to collapse with no effect on the other sides. We're seeing an economy that's just overheating and inflating at a ridiculous rate. And in order to slow it down, the Federal Reserve is having to lock up liquidity and start quantitative easing, which is impacting the stock markets and equities. And then this is all going to ripple on through to the housing market as well. Because it's a far less volatile and a far slower market, the housing market, it can take months to sell a home. Well, we shouldn't expect this to happen overnight. It's going to be a multi-year long phenomenon, but the trend is just incredibly clear in my opinion. Now, this doesn't mean that the governments are going to just sit by and let this happen. You best believe it that when Biden starts having his approval ratings hit by people's house prices falling, well, he's going to start putting into place policy to try and stop that from being a problem. We're already seeing this happen in the UK with the Bank of England getting rid of mortgage affordability rules, which is really scarily similar to what happened back in 2006. It's an awful idea, but frankly, in the Western world, most people's wealth comes from the homes that they live in and that they own. And so when those house prices fall, people feel poorer, they actually are poorer, they're less wealthy. And so it reflects on politicians and governments. And it isn't unusual at all for governments to be ousted because of something like a housing market crash. The real problem here is that these policies, they may work in the short term, they may prolong the bubble for a little bit longer, but in the long term, they just increase the amount of pain that is actually felt by the people who would have been affected in the first place. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.